Ever wonder why cutting costs doesn't always boost profit? Let's find out which cost lever actually moves your bottom line.
Let's start by decoding what fixed and variable really mean.
Every company spends on two engines of cost. Fixed costs stay constant: rent, salaries, insurance. Variable costs move: raw materials, logistics, commissions. Fixed costs create operating leverage. Profits accelerate when revenue rises, but losses deepen when sales fall. Variable costs equals a natural shock absorber. Balance both and you control your risk and your reward.
Your profit engine runs on structure, not slogans.
Cost structure defines how fast you respond to change. High fixed cost, less flexibility, but higher upside. High variable cost, more flexibility, but limited margin growth. See two factories. Factory A, high automation equals high fixed cost. Factory B, outsource equals high variable cost. When demand falls, A suffers losses, B adapts quickly. When demand rises, A wins bigger profits. Dual lines show revenue versus profit for both A and B. At low sales equals B higher profit. At high sales equals a profit skyrockets. That's the hidden lever. Operating leverage magnifies every decision.
Before chasing growth, find your break-even point.
Break-even equals sales where total revenue equals fixed plus variable cost. It's the foundation of profit control. X-axis equals units sold. Y-axis equals cost/revenue. Line 1, total cost, curving up with volume. Line 2, total revenue, straight rising. Intersection equals break-even point, marked with green dot. If you reduce fixed costs or lower variable costs per unit, that dot moves left profit faster. Fixed equals $300,000, variable equals $30 per unit, selling price equals $60, break-even equals 10,000 units. Cut variable to $27, break-even drops to 9,000. Every unit beyond break-even adds pure profit. That's the moment finance turns into freedom.
Sometimes, spending more is the smart way to save.
In growth markets, increase fixed costs through automation or capacity expansion. This reduces variable cost per unit and amplifies profit as volume rises. Line chart showing fixed cost per unit falling steeply with volume. Overlay, economies of scale effect. Imagine spending $1 million on automation. Your fixed cost rises, but per unit labor drops from $5 to $2. When sales double, profit soars. That's why high fixed cost firms dominate when demand is strong. But remember, with high leverage comes high responsibility.
In uncertain times, flexibility is your profit armor.
Convert fixed costs to variable ones, outsource, pay-per-use, or performance-based contracts. When sales drop, expenses drop too. Bar chart comparison. Before high fixed cost block plus small variable. After smaller fixed block plus larger variable portion. Label: risk spread across volume. Yes, margins may be lower in boom years, but you won't bleed in crisis. Think of it as profit insurance. Profit stability is a strategy, not a coincidence.
Not everything is black white. Some costs can be both in white.
Hybrid costs combine elements of both types, like utility bills or service contracts. Renegotiate leases to include variable portions, invest in energy-saving tech, or link supplier costs to output volume. Curved band illustrating semi-variable cost, fixed base plus sloped increment. Labels: step cost increase per usage level. By blending cost types, you gain control over volatility and profit margin. Smart negotiation turns static costs into strategic tools. When you negotiate structure, not just price, you negotiate freedom.
I'm processing the data now. Everything is running smoothly.
Use what-if profit simulations to see how cost mix responds to sales shocks. Run scenarios. Sales 10%, material price 5%, outsourcing contract switch. Dashboard with sliders adjusting fixed and variable ratios. Profit gauge responds instantly. Highlight: profit sensitivity map. Each move shows which lever drives profit the most. This turns CFO reports into real-time decision systems. Boards don't reward cost cutters, they reward profit architects.
Control the levers before they control you.
Your cost structure is the hidden engine of profitability. Ask 3 questions before every decision. 1. Is this cost fixed or variable? 2. How does it move with sales? 3. Can I reshape it for flexibility? The leaders who win don't just reduce costs, they design them.
If you found this insightful, subscribe and join me, Thanya, where we turn financial complexity